Hey, what's going on, you guys? How many times have you been in the market and you've taken a trade or you've placed an entry and you've placed your stop loss under a protected area? However, the market decided to stop hunt you, come down, wick you out, and go up into your intended direction. Or how many times you saw the market consolidating and you figured, hey, this is a protected area, it's respected. You know, price keeps stopping at this area. You take a trade, but price decides to bang you out and then it comes down in its intended direction. So these particular things are called liquidity grabs. And so the market is designed in a way where it builds up liquidity. And so liquidity is another form of money in the market. The form of stop losses, buy stops, sell stops, buy limits, sell limits, all of that is considered as liquidity that's building up in the market. And so the banks, they can see that. And when they see those type of things happening, you know, they're waiting for you to put that there because that's money that they're coming to grab. And so in this particular video, we're going to talk about liquidity, and we're going to talk about 4 forms that happens over and over and over again. And so we're going to show you guys how to identify them and how to trade them and build strategies around liquidity. That way you cannot be a part of the hunt, but you can actually move with the banks when these things happen in the market. Hey, you guys, stay tuned. I appreciate you guys joining us. Let's get into the video.
Then we capitalize on what we see. Want to go to Pitville? Come join the Pip Academy and learn the Pip drill. Let's take the trip to Pitville.
All right, you guys. So to start off, we're going to ask the most basic question. What exactly is liquidity? And so liquidity is defined to be the availability of liquid assets to a market or a company. And so we have to understand that in the Forex market, there's liquidity everywhere. Okay. And essentially, it's just orders that are in the market. And so you have these things that are called market makers. These are your central banks, you know, your large institutions and things like that. And so they have these algorithms that are designed to do one thing and one thing only, and that's to collect orders. So wherever the orders are, it almost moves like a magnet and it goes down to collect those orders. Okay. And so this is why a lot of traders will say things like, man, you know, the market is against me, you know, it's stop hunting my stop losses. And that's not that's not the actual case. It's just that that algorithm is designed to collect orders. So now you ask yourself, where are most orders in the market? They're typically at retail logical levels. These are your double bottoms. These are your support and resistance levels, your trend lines, all of these type of things. Now, why is that? And let's think about it. You have 2 different type of brokers. You have an ECN, you have a market maker. Most traders, they don't understand about that. They get with market makers. And so they're designed to trade against you. Okay. And so typically whenever you get with these brokers, you notice that they have free literature out there that says, hey, this is how you trade. This is how you do this. This is how you do that. And basically that's a way to manipulate you to think how they want you to think. Okay, since they're controlling the market, if you trade how they're teaching you to trade, then when you take a trade, they're going to take a trade against you. And so that's how that algorithm is built into, you know, almost trapping you into liquidity traps. Okay, so now let's go ahead and get into this. All right, you guys. So to start off, we're going to talk about the 4 forms of liquidity that I deem to be the most important because I see them on a daily basis. I see them over and over in the market. And so the first form is considered to be relative equal highs and lows. And so to understand this particular form, you have to understand the psychology of a trader. And so by looking at this particular model, you see a lower low, lower high, lower low, and you have a breakup structure in this area right here. Okay. So let's mark that. All right, we have a breakup structure. And so most traders will say, okay, price will possibly retrace into some order block or demand zone and then shoot to the upside. And the most logical place to put your stop loss is here. Okay, this is how we all think. You want to put your stop loss under protected areas. However, the banks, you know, they can see order books. And so stop losses are pretty much forms of money. You know, liquidity is another name for money. So in these areas, you know, the banks can see all of these stop losses. They can see buy limits. They can see, you know, buy stops, sell stops. All of this money is building up in this area. Okay. And so let's look at an example like this. Let's just say if you were taking a trip. Okay. And on this particular trip, in order to get there, you have to fuel up on gas, okay, in order to make it to that trip. So what the banks will do, they'll come down, they'll add all of this liquidity in this area, where it logically will tell a trader, I will put my stop loss under these areas. And when the bank is ready to take their trip, they finish getting their gas and all of that type of thing, they'll shoot down, take all of that money, they'll take all of this money, and then they'll shoot in its intended direction to take their trip to go wherever they want to go. So that's how the banks think, and that's how relative equal highs and lows in essence works. Okay, so we have to be mindful of these traps, and we want to make sure that we're paying attention to areas that could possibly have liquidity that the market wants to come and take. Now, this form here is probably one of my favorite models to trade, which is considered to be buy side and sell side liquidity. And so with this particular model, when price kind of retraces, when price retraces, we want to look for some supply zone or something like that, and we want to target the sell side liquidity in this swing low here. Price come down, take out the liquidity, and then we rinse, recycle, and repeat. Supply zone here, this is our target, price come down and take that out. Now, also one thing to consider with this model as well, as we understood how relative equal highs and lows work, we have liquidity building up in these areas as well. So at some point in the market, price will decide to come and take all of this liquidity here, giving us a break of structure, okay, come down, and then it'll shoot in its intended direction. This happens all the time. Okay, so we just got to be vigilant on how we look at the market and make sure we wait for confirmations and things like that. Next, I think is probably one of the most underrated models of liquidity that we see in the market, which is the session high and low liquidity. Okay, now specifically the Asian session range. And when you're looking at this particular model in the market, 90% of the time, when the London session opens, it will either sweep the high and low of Asia and then turn right around and sweep the lows or the highs, depending on the direction that it's going. But this happens over and over and over again. And a lot of times this happens with each session. The London will sweep Asia. The New York will sweep London. Okay, and then at times the Asia will sweep New York. And this, like I said, this is a rinse, recycle, repeat. It happens over and over and over again. And so you can literally build strategies around session ranges. Okay, and like I said, this is probably one of the most underrated liquidity models in the Forex market today, but it's actually one of the most important. Okay. And last but not least, we have the previous daily high and low liquidity. Okay. And so with this one, as we can see, we have a daily candle here. And a lot of times what will happen is the next daily candle will come, take out the liquidity of the previous day, and then it'll go in its intended direction. So if we look at this particular candle in a smaller fractal form, it might look something like this. You can see initially price was bullish. It took out liquidity, and now it's going in its intended direction. It broke structure, gave us a pullback, and now it's possibly going to take out the daily low liquidity. Okay. And so, like I said, these four forms you can see almost every day in the market. All right. All right, you guys. So we're going to look at some examples in the live market. I'm going to break down how you guys can identify them, recognize them, and how you can build strategies around the different liquidity examples that we presented. Okay. So as you guys can see, we currently have some color-coded boxes around each session. And so if you go to indicators and you type in Sonar Lab sessions, okay, and you want to find trading sessions by Sonar Lab all right. So once you get this indicator, you probably need to tweak it a bit and kind of manipulate some of the numbers, because it depends on which Well, it depends on which trading session or which time zone that you're in, okay? And so for Asian session, I'm currently on Central Time. So here are some of the time stamps that I had to kind of create for myself. So if you're looking at Asian session and things like that, for London session and things like that. So for me, I know the different sessions overlap. However, I wanted the sessions to stop as soon as the next session start, okay? Because you only need a couple hours within that session to see exactly how this indicator works and how you can recognize the liquidity within those particular different areas, okay? So now within this particular indicator as well, you have your days of the week, okay? And as you can see, you can separate your days and the dividers for the different days and the different trading sessions as well, okay? So let's start from current price, and I'm gonna show you guys exactly how this works. Specifically speaking of the Asian session range. And we talked about how when previous markets come in, they'll sweep the highs and the lows. So if we're looking at the Asian session here, we can see when London started, it swept the lows, and then after a while, during the New York session, it swept the highs. New York took out Asia and London, okay? And this happens over and over and over again. So if we look at this particular example here, we can see that London took out the highs. In New York, it took out the lows here, okay? In this particular example, we can see immediately in London, price took out the Asia highs, and then it swept the lows. Okay, and like I said, you guys, this happens over and over and over again. So in this particular example, we can see price didn't quite take out the highs. However, at the open, it took out the lows, played around a little bit, and then New York swept the highs and the lows of London. Okay, and so we can see how the session high and low liquidity points can be really good examples that you guys can utilize to base your trades off of, okay? So now let's take a look at daily high and low areas, okay? So what we're gonna do, we're gonna remove this indicator for now, and we're gonna look at the market from a daily perspective, okay? Oh, you know what? I need to bring that back on. Here we go. All right, so here we go. So let's just say we were looking at this area here, and we can see this is a daily high and a daily low. And one of the things we can see is this current trend initially was bullish and it decided to break structure. So it took out the daily liquidity, price came up, gave us a retest into the supply zone here, and then price decided to drop off, okay? Another thing here, so now we can see that we have a daily low here and a daily high in this area. However, what do we see in the middle of this area? We see a pool of liquidity being built in this area here. We have all of these relative equal highs and lows with all of this money just building up in this area. And so what did price do? Price came down, and then price decided to take out all of this liquidity before it went in its intended direction. And this happens over and over and over again, okay? And then from there, it took out the lows. And so we mentioned that price will, in essence, fuel up. This is all of the fuel. It'll fuel up, take it, and then it'll go in its intended direction, okay? Let's look at another example. Okay, we can move it over to this Monday right here. We can see for Monday, going into Tuesday, we had a high and a low. However, in this area, we had what? Relative equal highs and lows in this area. We had money and liquidity building up in this area. And so price, we can see on Tuesday, price came up, it swept the highs, and then it swept the lows. Okay, and this happens over and over and over again. So you guys can see how looking at the market, you know, it'll give you better clarity as to liquidity and how it builds up in the market. And we can build our trading strategies around liquidity and target those liquidity areas. And if we're looking at this from a sell side and buy side liquidity perspective, we see that we are bearish in this area here. And so what do we say? Price comes up, we're looking to take out the liquidity here. This can be our TP, and it's based around a previous day high strategy. Hey, you guys, I hope this was informative for you, and I'd like to thank you for watching.
Then we capitalize on what we see. Wanna go to Pitville? Come join the Pip Academy and learn the Pip drill. Let's take the trip to Pitville.